All right, so today we'll be talking about we'll be presenting about the Dojima Rice market and the origins of future tradings. First, we're going to cover the historical context of it and what it was and how it developed, and then we will go and talk and discuss more about the influence and what it has still currently today in modern day economics. So to start, it's important to understand how important rice was to the market of Japan and to their economy. Rice affected everything. The price of rice affected even their monetary currency of silver. And if rice prices went down, the price of silver also went down. And so rice was not only how they survived physically, but survived economically. And Yoshimune, the man who took power, the shogun who took power, recognized this and understood this principle throughout his time as the shogun in Japan. And at the beginning of his reign, he recognized that rice prices were starting to fall, and they fell by about 40%. And he's recognized that he needed to do something in order to keep himself and his friends and followers, the samurai, in political and economic power. And so he decided that he would start putting his future on future tradings. And so when he established it, he didn't make it technically legal. It was very under the table. Very few merchants had the availability and the permission to do so, but widely known, it was known to be illegal. And this, over time, started to have the reverse effect that Yoshimune thought it was going to have. It actually started negatively affecting the samurai and started supporting the middle class and the merchants. And so that became another problem that he started to recognize, is that as time went on, the samurai were also starting to lose power economically, and the merchants who were just simply trading the rice, they began to gain economic and political power because of the future tradings. Next slide. And so then during this time, there was three main kinds of trades that we want to talk about today. And the first was forward contracts, which is, I guess, this is your basic type of future trading, which is trading and buying based on what rice and prices will be in the future. And so they would buy certain percentages of future harvests, and that would affect how they sold, and they could make more revenue off of those as well. And then there were two kinds of bills that also came to play. They also started to come around. One was backed bills and unbacked bills. And backed bills were legal bills that all merchants used. They were simply, you would show up at rice market at the wherever it was, and you would buy 1/3 of a certain percentage of rice, and you could hold that percentage until a couple of days later, up to 30 days, and then you would go back and sell it, and you would receive a bill for the amount of rice which you bought. And that was just another way that they made a little bit more profit and revenue off of their tradings. But the problem was that it wasn't regulated very well, and most people kept them for more than 30 days, up to a year, which boosted the revenue, but really negatively affected everyone else. And then the other kind was unbacked prepayment bills, which was saying and buying contracts of rice bills that haven't even been harvested yet, of rice that hadn't even been harvested, hadn't even come to market. They had just decided that they figured it was going to be a good year, and they bought it ahead of time, and then they got it sold back to them. And this practice was also prohibited by the shogun, but it was still pretty common among the traders and among the merchants.
So rice futures trading developed as they practiced it more often. And in 1693, Osaka merchants started to do their first initial rice future tradings, and these were not permitted. And a year later, the Edo merchants and government put a ban on all of this, and so the reason why they put a ban on it is because they saw it as a form of gambling, and it was affecting the actual price of rice. And what continued on is throughout time in history, depending on the price of rice, if the price of rice was high, they would put a ban on trading, any future rice trading or any trading of rice bills. And if the price was low, they would turn a blind eye to it and allow it and not put anyone in jail or anything like that. And then about 1697 is when Dojima, the island, like kind of opened up and people started moving there, and the rice market shifted to Dojima, the island itself. And then in 1715, the shogun officially allowed Edo merchants to open up the first official Dojima market to where rice bills could be traded. And the only rice bill that was allowed was backed auction bills. Next slide. And so the essential parts of kind of how the rice bills were traded was warehouses, credit houses, and clearinghouses. And warehouses were owned by lords who would bring in rice and they would sell it to traders, and then all the disbursements and everything afterwards would go to the lord and the financial agent, and the financial agent would eventually pay back the lord in any way. And then credit houses were used to leverage people's loans that they had. This was used so that they could extend their loans and not be able to default on them, because if they defaulted on them, then they would, their futures trading profile in a sense would be diminished. And then the clearinghouses was the most essential part. It's where the daily actions of everything went on, where people would sell their bills, buy bills, and the clearinghouses would take transactions and disperse them. And then Yoshimune takes office in 1716 as the market is still official in Dojima, and he lets it run for a couple of years, but in 1721 he closes the market officially because he sees the price of rice is very high and decides to close it, even though the reason why rice was high was because they had poor crops in 1720 and 1721. And about an 8-year period throughout that time, he would close the markets, open them, close the markets, open them, due to, depending on the price of rice. If it was high, he'd ban it. If it was low, he'd open it back up, but not officially. And then in 1730, the Osaka merchants came to him and wanted to market to where futures trading was allowed, but you had to have a license in these tradings, but that was never permitted.
All right, kind of just to go over what we've already covered, a few important things to take note of before we start talking about the future application of the Dojima rice market is that the Dojima rice market was the first recorded organized futures trading market. So in today's world, there's obviously a lot of futures trading going on. In 1715, when the Dojima market was made official, that was the first recorded futures trading that we have. Obviously, that's super significant for today because it was the beginning of a new form of trading. In Japan in the 1700s, they traded futures backed by rice, whereas today we don't really use rice as a currency anymore. It's more backed by stocks, backed by currency, things like that. Another thing to kind of take note of that was interesting is that the relationship between the merchants and the samurais is kind of similar to the relationship between the average population and Wall Street brokerages, where the merchants and the average people of today are kind of, they're able to make gains through trading, whereas Samurai and Wall Street brokerages, they kind of already have that, the established, I guess, basically they're rich. But, and the average people and the merchants are able to kind of make their fortune through futures trading. E-Trade, which we'll cover in a little bit, it's an app that allows average people to be able to trade future stocks, and it kind of bridges that gap between Wall Street brokerages and the average person. Some things to take note of with futures trading, with the digitization of it. A few things that happened when we made futures trading digital. It increased the accessibility to everyone. Obviously, most people in the United States and globally have access to the internet, so they're able to trade easier. Whereas if it was in person, they would have to travel to one specific place with their money, with their trading, and trade there. It also made it very easy, and it encouraged the public to invest more, so we have more investments going. It also expanded the futures market, so now instead of just doing rice bills, we're trading stock, currency, precious metals, cryptocurrencies, things like that, where we're trading a lot more types of currency. Digital platforms have also transformed futures trading by three very important things, by liquidity, speed, and volatility. These three kind of aspects of futures trading have changed significantly since the 1700s when Japan first started futures trading. The liquidity, we have a larger amount of people trading, so naturally there's going to be more money in circulation. People are going to be buying more futures, selling more futures than in the 1700s. The speed, obviously the digital world is very instantaneous. It's almost at light speed that you can trade and have currency traded between people. So they're able to execute trades a lot faster instead of having to organize a meeting place, organize a meeting time, travel there, get the money, exchange the money. It's just a lot less hassle. Volatility, obviously when things went digital, people were able to place larger orders. We had more people trading, so the market was able to, there was a lot bigger swings in the futures trading market because we have a lot more money in circulation. Trades can happen a lot faster, so you're going to see a lot more swings in the market.
Make sure this is working. Cool. Okay. So Ashley did a great job bridging the gap between the past and the present. So brokerages are not a new thing, obviously. They've been around since, well, almost since 1700, but the brokerages we're going to be talking about today are the modern day within the last 5 years. They've changed a lot. So especially when you look at online brokerages, but let's just take E-Trade for example, because that's who we're talking about here. E-Trade started around 1980, 1982 was when they first started trading online stocks. Quickly developed into futures trading, options, all kinds of derivatives. You know exactly how that is, derivatives all over the place. So William Porter is the founder of E-Trade. He was inspired by Charles Schwab. I'm sure all this will be talked about more with Andre. But what's really important to know is that E-Trade was established in 1982 and just grew, and the app is continuing that. So like Ashley said, we're talking about how the app has been able to, once again, establish much easier access for the common people. That is a huge difference here. And another really important thing to know is that the quantity theory of money is relevant here, because as more and more people are using this app, it increases the velocity of money being used. So that quickly expands the market.
All right, so now we're going to talk about artificial intelligence. And so in recent years, artificial intelligence technology has evolved in such a way that it can be adapted to futures trading. And in that way, I mean, artificial intelligence allows you to harness a lot of historical data and can analyze and make decisions faster and quicker and very much efficient. And so we have two types of artificial intelligence technology. The first one we're going to talk about is natural language processing. So what is natural language processing? Natural language processing is a computer technology that mimics the human way of understanding a language and can therefore analyze huge volume of text, voice, documents to identify the key trends in market. The natural language processing can sift through structured and unstructured data. And structured by what I mean is it can go through financial data and market price. And unstructured data includes newsfeed like Bloomberg News, Yahoo Finance, and also social media, right? And Twitter's, Elon Musk can tweet something and the price of Bitcoin can go up. And so natural language processing takes all of this in and it gives you like a quick summary so that traders can quickly identify the relationship between the data and what's their next decision. The second type of artificial intelligence is machine learning. And so the way the machine learns, as it implies from its name, machine learning, is that the more data that is exposed to, the more historical trends that it's exposed to, it can provide better predictive capabilities. And so right here it says that it can gather data from multiple sources and can also provide useful insights to traders so that they can trade more efficiently with more productivity and they can have higher gains. Next slide, please. And so with the artificial intelligence technology, there is going to be a lot of regulations and surveillance. And so high frequency trading as a result of artificial intelligence has increased spoofing practices. So what is spoofing practices? It's basically when a trader wants to sell a derivative contract and wants to artificially increase the demand for that derivative contract. So for example, if the derivative contract is currently selling for $10, if the derivative contract wants to be sold at $10.20, but the market wants to buy it at $10, and so the trader that wants to sell the contract will go into the buy side and enter a large number of buy orders to artificially increase the demand to $10.10. And so when the queue ends at $10.10, the trader that wants to sell off the derivative contract would pull back his buy order, but he has already made the gains on the sale of his derivative contract. And so in 2019, JP Morgan actually paid $920 million in fines for this spoofing practice. And they did this spoofing practice in precious metals future and US Treasury futures contract. And so there are software that helps detect this spoofing practices. They are not very well known because if finance firms like J.P. Morgan and Goldman Sachs would know all of these software technology that can detect spoofing, they might find a way to get around it. And so the next law that comes into place is Commodities Future Trading Commission has adopted a position limit for derivatives in 2020, I think in 2021. And so position limit is basically the pre-established ownership level that is set by the exchange that limits you to a number of derivatives contract that you can own by a firm or by an investor. And so Armadillo Holdings bought 240 and 100 tons of chocolate for just over $1 billion. So they are buying the physical product of hundreds of thousands of tons of chocolate, and they're hoarding it, and so it causes a lot of market volatility, because when you're hoarding like at least like around 7% of the world chocolate trade, like that's a lot, and you can have like authority and power to just increase the market price as you wish. All right, thank you.
I'll do the conclusion. Alright. So in conclusion, we've talked about a lot of things going from 1710 to 2021 with the chocolate trade. Just to reiterate that 1700s, the futures market started, and in 2021, the futures and other derivatives market is huge and able to be accessed by everyone, normal people and otherwise, just on your mobile app. And so that's where all this technology comes from that Andre was talking about, with the machine learning and now controlling the market. So thank you for listening to our PowerPoint. Attached will be the citations in APA format. Just thank you for listening.
That was 22 minutes and 30 seconds.
Look, if we